Good afternoon, or good morning if you're on the West Coast like me. This is Jed Brewer with Below the Line Club and Study Groups. Really thrilled to have you on the call today as we talk about buying better and delivering better, two key things that separate top performers in our industry, the buy side as well as cost to serve. So really pleased to have two experts in both of those domains join us. The first is David Thompson with Powerhouse, and he's the executive vice president there. And Powerhouse is I would say a hedging company, but I'm sure he does a lot more than that, but helps broker transactions for various firms. But David has a lot of experience on financial markets and commodities markets and so forth. And today he's going to be talking about how we can use technical analysis to buy better. So we probably heard that term technical analysis thrown around before. So he's going to talk a little bit about what it is, the theories underpinning technical analysis, and really most importantly, how can we apply it to our companies to make better buying and selling decisions. So David, real pleased to have you on the call. And then we'll transition right after David to John Monalepri, who's vice president of Row Logic, and talk more about how can we deliver better. And we all know that that last mile, getting the product to the customer, is one of the key things that, again, separates those top performers. So John's going to talk some about how do we use automation to shorten that overall life cycle of the product, become more efficient, and ultimately better operators. So that's the game plan for today. Before we dive in, just a couple quick ground rules. We want this to be as interactive as possible, as informative as possible to you as well. I have you muted, so if there is something, question that you want to ask, we want to make sure we can get that answered. So in your GoToWebinar dialog box, there's an area for you to type in your questions. I will be able to read those questions, and I'll interrupt the speakers at the appropriate time and relay that question to them so we can get your questions answered. So please feel free to ask questions and do that through the GoToWebinar framework. Both of the slide decks that are here, the presenters have agreed to make available to you. So at the close of this, I'll not only send the recording of the broadcast, but also the slides out to you should you have any follow-up questions for the presenters, or should you want to share this information with a colleague on your team, or just relook at it yourself. So without further ado, let's go ahead and jump in. So David, give us a little background on technical analysis and how we can ultimately use it to make better buying and selling decisions in our firms.
Thanks, Jed, and welcome to everybody, and thanks for dialing in and webbing in, and appreciate the chance to talk with all the study groups members. What we do using technical analysis, we use this tool every day in the course of our work with our customers, who are jobbers, retailers, end users of fuel all across the country. And many times we're faced with the decision, we have to make decisions in an environment where we have less than complete or perfect information. And technical analysis is a tool that you can use in combination with everything else that you do to help make a more informed decision. Really, what we often see when we're looking at news sources is things similar to what we see on the slide right here. These are two recent stories, and they just keep coming up again and again, where we have information that comes across the news wires or on TV that seem to defy the basic laws of supply and demand that we all remember. In the first story, we hear a thing in Europe about how distillate diesel crack spreads are dropping despite a decline, a fall in stocks. Sort of once again proving that, when you think of, less supply, price should go up. Not always. The story at the bottom, this was from just a few weeks ago, heating oil futures extend losses even though the API shows larger than expected decline or draw in inventory. So once again, stocks down and prices also going down. I often talk to my colleagues here and say I'm going to call my university up and ask for a refund on my Econ 101 credits, because as we wrestle with markets, we see time and time again how there are times when markets simply don't seem to make fundamental sense.
Well,
This
David, I'm
story
against
was actually
the refund of your econ credits. You put us economists out of business.
Well, you can charge me for an extra class. We'll certainly make that a possibility.
Sounds
this
fair.
story is one of my favorite slides. This is from 10 years ago, and it was wonderful because somebody finally just came out and said what all of us have been thinking. This was 10 years ago. Oil futures, talking about the NYMEX crude oil contract, one of the largest physically delivered contracts in the world, and talking about crude oil futures trading higher, seemed poised to sort of the highest level in nearly 20 years. And the line in red that I highlighted in the bottom paragraph is from a well-respected analyst who said the market seems to be showing an unwillingness to pay any heed to the fundamental picture. And this happens, as I said, again and again, and we have to decide, well, what the heck are we going to do? Technical analysis is just simply the study of price action. What we're looking at is simply, be it the price of heating oil, gasoline, diesel, crude oil, growth stocks, the euro, pork bellies. It can be the price, anything where you can get a series of price information and you can make a chart, and then we can analyze that price behavior. The thinking behind it is that money is either made or lost on those price movements. So let's concentrate on just the study of those price movements. Technicians believe that price action tends to repeat itself because human beings do not make rational decisions at all times. And there are factors, things like seasonality and crowd herd behavior that play into the markets. And so markets tend to develop trends, and these trends often repeat their patterns over and over again. But the most important thing in all this is that some people think that technical analysis is against fundamental analysis, or is the opponent of it. It's the opposite of it. It's not at all. There are two schools of analysis, and they should be used in concert. I always make the analysis of looking at a road map. If you were sitting on the West Coast and somebody told you had to drive to the East Coast, would you rather have a map like this, or would you rather have this map? Of course, you'd rather have the complete set of tools. So use things together. And we work through these, a couple of points when we're going to talk about some of these tools. We'll just have time to go over one really, but think of it as something working in concert with what you're doing. I always say that our job is to analyze information, and useful information is art. It's accurate, it's relevant, and it's timely. We have to have all three things to have really useful information. This is a slide of a report that comes out every week from the Commodity Futures Trading Commission. It's called the Commitment of Traders Report. Some of you may look at it from time to time. It gives a government report of what entities and what categories of entities hold large futures positions, which as somebody who trades futures is very important. Do the large hedgers have more long positions? Do the speculators have more short positions? How have these numbers changed from week to week? It's all very important. It's a government report, so it's very accurate. People make sure they get their numbers right when they submit them. But the only problem is it comes out once a week and it comes out 5 days after the fact. So it's not very timely, and it's difficult to make a decision today based on what I'm looking at from 5 days ago on the CFTC website. Here's another source of information. It's certainly relevant. He talks about the stock market all day long, and he's talking every single day as minute by minute as the trades are going by, but I'm not exactly sure he's all that accurate all the time. So we're stuck with something like this, a price chart. I would contend this is all three things: accurate, relevant, and timely. This is a crude oil daily chart. The point in the middle was the date of the attack on the Saudi oil facilities. The information on the bottom shows the volume traded. If we need to see a daily chart, we can see that. We can have an hourly chart, a minute chart, a monthly chart. We can get any time frame we need, and we're getting literally live data coming in. So it's all three things, and I think it offers a lot of useful tools to help us make decisions on buying and selling. One thing that for those of you who may say, well, I'm more on the physical side, I'm not sure I understand these energy futures markets entirely, a quick snapshot of what they are. The energy futures market is really an auction process. It matches buyers and sellers. One thing that I always see on TV, and it makes me cringe a little bit, is when I hear people say on a day when prices are up, they make the joke, and well, there are more buyers than sellers out there. That's why prices went higher. Of course, that can't be true. There have to be exactly as many buyers as sellers, or else you'd have an imbalance in the market. What the market really does, the futures market, or really any market, is it represents an intensity gauge. And this is one of the key factors in understanding the technical points we're going to talk about, is intensity. In other words, somebody is making a bid to buy something and somebody is making an offer to sell something. And there's a gap between those two prices. What the market movements tell us is who is more intense, who has that greater desire. If the person is very, very bullish, they're going to go and take that offer. They're not going to wait to negotiate for a lower price. Similarly, if the sellers are concerned that prices are collapsing, they're not going to hold out for a higher price. They'll sell at that bid that they see right then and there in front of them. So it's who crosses that gap, who displays more intensity. That determines what moves the price. And sustained intensity is what generates a trend. And that's what we try and look at as we're looking at charts, is to see, can we notice trends breaking down, trends starting, changes in trends, and what tools can we look at that can help us perhaps get a little bit of a head start on understanding when that's going to happen. One of the most interesting ones to look at is this measure of, again, measuring intensity of fear and greed. This is in the old days what fear and greed used to look like. This is the picture from one of the old trading pits. And you can literally see the expression of fear in the eyes of people in this picture. And somebody just has to buy or sell at a certain price. This has largely been replaced now with electronic trading, but yet we still have the same dynamic going on because we're human beings and we care about the effects of gains and losses on our businesses, on our portfolios, on our financial bottom lines. So the human dynamic is still there regardless of how it's transacted. Technical analysis really comes down to assessing this battle of fear versus greed. And on charts, we call that bears versus bulls, up versus down. What we want to talk about in our little brief time today is one of the cornerstone technical indicators called the relative strength indicator. The relative strength indicator is a momentum indicator, and we'll talk a little bit about what that is. It was developed all the way back in 1978 by a man named Wells Wilder. He actually did it with a handheld calculator and graph paper. I have a copy of his original book that he laid this out in, and he literally photocopied pictures of graph paper and included them in the book. So long before we had supercomputers and artificial intelligence, there were people who were trying to use technical analysis to glean changes in trend and intensity in the market and make better buying and selling decisions based on that. I won't go into the whole lot of math here. I know that'll hurt Jed's feelings a little bit, but we'll skip it. But the relative strength, when I say it's an oscillator, what it does is it tries to measure the magnitude of recent gains in the market, be it, again, heating oil, gasoline, diesel, crude oil, whatever the commodity, versus recent losses. And it turns that ratio into a number that ranges between 0 and 100. That's called an oscillator. So it gives us a measurable scale of intensity. As the number moves higher, that means the recent gains are greater than the recent losses, 100 being the high end, 0 being the low end. Wells Wilder recommended using certain levels to define conditions called overbought and oversold. This is something you hear a lot on TV and you say, what on earth is that word? Overbought represents when that oscillator has moved above the 70 level. Remember, again, it's a scale of 0 to 100. So in other words, the buying has been so intense that that level has pushed above 70. They came up with the clever term overbought. And of course, if you have that, then the inverse, when the market is selling off and prices have driven that indicator below 30, they came up with the term oversold to represent an extreme level of buying or selling intensity, respectively. And that's going to be one of our keys that this indicator helps us look at, is when these conditions reach extremes, we can expect potential changes in the trend. In other words, bull markets to end or bear markets to end. If you think about it, back in the old analogy we used to learn when we first started learning about gravity, when you think about Isaac Newton and the apple falling on the tree and hitting him on the head, I remember a teacher told me about momentum and gravity and saying, think about the other way. When you toss an apple in the air, it goes up. And then at some brief moment, for just a tiny fraction of time, it's floating and it's not neither going up nor yet coming down. And that point, the momentum is ceased, and then gravity starts to pull the apple back down. So there's that changing in momentum, that the ebbing of intensity before a change in trend occurs, or change in direction in the case of the apple. That's one thing that relative strength will help us see on charts. So what does the relative strength indicator look like? If you have a computer, if you look at your prices, on any websites or prices, anything with technical analysis tools will probably have relative strength on it. It's one of the basic bedrock indicators. It's indicated in light blue on the bottom under RSI. The top price is the heating oil futures contract, a daily contract. And you can see they look like they're pretty much going along together. But if you notice with the trained eye, you start to see that they're not exactly following, and there are some discrepancies between the price action in the upper panel, and that's futures prices, and then the bottom level, which is that construction of the momentum indicator, the momentum oscillator. And this is what we use to determine when we see breaks in trend. One of these tools we mentioned.
What's the frequency that you look at this at? I mean, should you be looking at this hourly? Should you be looking at daily, monthly, yearly, in terms of trying to understand the relative frequency?
Sure. This chart right here is a daily chart, and I'm going to have two more examples showing actual things that happened in the market. One was on an intraday chart. This might be the determination of, let's say somebody has a determination of a hedge position that they need to exit. And they've acquired their physical fuel, and they're saying, geez, should I sell my hedge position immediately, or is the market going in my favor? Maybe I could squeeze out a little bit more money before I exit my hedge. Or if I had to recommend to a customer, I've got a big end user of fuel who keeps calling me up and says, prices have been coming down and that's been good for me. I haven't been buying yet, but how much longer do you think the market can go? Well, none of us, of course, know, except that if we could see some technical signals that might be telling us the downtrend was, running out of steam and was preparing to turn around, that would be useful on perhaps a daily or a weekly look to give to your clients. So the great thing about them is they're scalable to any time frame. Most of our customers in the fuel business look at either a daily chart or sometimes an intraday chart. Most of the time, if you're looking for a big seasonal picture, something like when to launch a heating oil cap program for the winter, you might look at a weekly version, but for our purposes, it's usually daily or intraday.
Thank you. That's helpful. Shorter time frame is more actionable, is what I hear you saying.
For most commercial participants, yes. So we talked about overbought and oversold, and we talked about how overbought conditions depict a market that has been subject to a lot of sustained buying intensity. When we see a breakdown in that RSI level from those high levels, remember that was 70 was what they called overbought, to below, that signals to a technician that, hey, this bull trend might be coming to an end. It might be starting to weaken. Similarly, if we're below 30 on the RSI and we see it move up above there, then we get an idea, maybe the bears are finally running out of steam and it's time to start looking to be a buyer. There's another technique called divergence, and we're going to put these two together. Divergence is really powerful, and it's probably something I use as much as anything when I'm advising clients. Divergence is, what we're talking about diverging is the technical indicator, and it can be, lots of technical indicators can show divergence. In this case, we're talking about the relative strength indicator. If the relative strength indicator is giving us a different read than what the price action is giving us, that is a big clue. In other words, if the price action is bearish, the market is moving lower and lower and lower, and yet I start to see my relative strength indicator not follow exactly in that line, in fact, do the opposite. That starts telling me that in that case, with the bear market, that maybe there's a little bit of bullishness creeping in. In other words, the intensity of this most recent push down in price hasn't been as intense as past pushes lower. And that goes back to that Apple idea. Maybe it's starting to run out of steam. And it gives me a little bit of if nothing else, it gives me an alarm bell to say, hey, start paying attention. If you need to buy, you should start looking right now. Again, the last point, divergence tends to highlight that decay of existing market dynamics, the existing trend. So let's take a look. This was a 10-minute chart. So this was a couple of days ago on November 8th. We had seen the market in the top. I have the bars going on. It was about 6:30 in the morning. Price was at, this is ULSD futures. Price was at 188.72. The RSI at the time was at 2190. It had made a low, and you can see that RSI is below the 30 level, so we're had some sustained selling pressure, driven us lower. And then the market sort of bounced around, went sideways for a while, and then, you know, a little bit before 10 o'clock, it started selling off again. And you can see we made a new low in price at the 10 o'clock mark. However, at that same time, I look down and I see at the RSI and say, the RSI is at 26. So even though price made a new low, the RSI did not. That's the definition of bullish divergence. So at that point, we started paying attention, you know, and saying, if somebody needs to buy something, this might not be a bad spot to take a stab at things. Turned out that was pretty accurate, because shortly after that, price really started moving up and almost added 3.5, 4 cents in the matter of a couple of hours. So this is a very simple thing that you can have on your computer screen. One of the biggest things I think a lot of people do is they have too many sources of information. Remember, you know, the ART. If you have too much of it, it doesn't matter how RD it is, it's just too much to look at. But, you know, relative strength is relatively simple. It's visual, and you can look at it quickly and say, I see this is, you know, that last push down in price was not matched by a corresponding new low in the indicator. That's that divergence dynamic going on. And again, also, the RSI was below 30 to start with. Again, something that would, once we started moving above here, we start to get a possibility of looking to be a buyer. It can also work on a much larger time frame. This was a picture, again, of diesel futures. But remember, this was back at the end of last year when we had that big, huge slide in just about every price. Crude oil, the stock market, fuel, all of it went down from basically all of Q4 last year. But notice, here's our RSI indicator. In this case, we were above 70 back in early October, right about the time prices were at a relative high point. And things started moving lower. So this might have been a clue here, once this broke down, that if you had a long position, you know, you might want to sell that. If you had inventory, you certainly want to start to hedge and protect yourself, because we've seen a breakdown in this bullishness. And sure enough, we had just solid 3 months of selling as we moved through September, October, November into December. But we noticed here in November at point number 2, that we made a low. This was a significant move down, and you know, I picked this point because at this point it looked like, okay, the market has sort of paused for a bit, and we look and see, I see the relative strength indicator is oversold. It's below the 30 level. Okay, well, let's keep an eye on what's happening. As we move along, we see yet another lurch down as we went all the way into, you know, New Year's. And here again, a new low in price, but not a new low in the indicator. So that once again gives us that bullish divergence signal. Start paying attention if you need to be a buyer. This happens to fall right in line with the seasonal pattern as well. So again, it's a tool in the toolbox. We're incorporating all these things in our decisions. We're usually looking to be buyers of diesel fuel around the end of the year anyhow, because that's a historical seasonal pattern that tends to bottom there. But then we saw a nice advance in price since that time, first display of bullish divergence. So keep these things in mind as you're going through. Again, they're a simple thing to add on your chart. It doesn't really require a lot of mathematical computation. You can look at it visually and get a quick idea. And it gives you what I always call an alarm bell. So something to start paying attention to, and it works both for buyers and sellers. That really is the takeaway that I want everyone to hopefully get from this, is that you can look and see quickly, concisely what you're looking for. Once you understand the quick little setup of what overbought and oversold are, it becomes something you don't even have to look twice on. Technical tools can offer you insights when the market gives you fundamental news that just doesn't make any sense, or there just isn't any. There are plenty of times in the middle of the day where markets are moving and there's no headlines hitting the news wires. And clients call us and say, what's going on? And you know, by the time they write the news story, the market's already moved 3 cents. We often get calls from reporters all day long saying, what's going on? And, I can tell them what I see from what I hear from my clients or what I hear in the market or what I'm seeing on a chart, but they still have to go and write the story. So by the time it shows up in the news service, it's at least 30 minutes old just for the fact that the reporter has to write the story. And finally, technical analysis tools are just an additional tool in your toolbox, another weapon in your arsenal. It doesn't mean you can't do what you're doing right now as you make decisions, but why not have something else to help you out when you're looking to wrestle with these markets? So that's really the gist of what I wanted to give you. Keep an eye out on simple technical tools that can help you make better decisions on how to buy and sell.
David, thank you. And just a reminder to the audience, if you have questions, please type those in and we'll relay them to David and John. A couple questions for you, David. So you talked about overbought and oversold, and when you go in there when it's above 70 or less than 30, do you have a sense for the percent of time that we're either in an overbought or oversold condition? On your charts, it looked, I know you're just pulling out a sample, it looked like, a couple percent of the time, the vast majority we were in within those bounds. Do you have a sense overall for markets?
It depends, certain markets at times of the year are more volatile than other times. So that certainly determines things. And the nice thing is most of the time we're not in either overbought or oversold. So therefore, when you see that develop, again, it's something to pay attention to. They set those numbers, and some markets are different than others, and everybody, I would highly encourage them to look at their, if you're a gasoline guy, it might be a slightly different, maybe it's 72 and 28 are the numbers that really, bound your markets. And I've done a lot of that work with the different commodities myself, and I'm happy to share with anybody who wants to kick that around. That's the fun part of my day. But they're not designed to reach overbought and oversold on a regular basis because we're trying to measure extremes of the market. So it's a relatively small percentage of the time you'll reach those levels.
That makes sense. And another question. So we were talking about overbought and oversold, and you were coupling that indicator for relative strength with divergence and saying if you put those two together, it's powerful. You don't necessarily have to be in an overbought or an oversold situation. You can be within bounds and still have divergence in the price action, and there can be useful information then. Is that correct?
You could. It's when it gets stronger. For instance, if I were looking for bullish divergence, in other words, I want to be a buyer for whatever reason. And if I saw that the indicator was at, say, 40, so it's not in oversold territory yet, and then the next reading is at 42, and yet the price action was going lower. That's technically, you're correct, that is bullish divergence. It may just be less of a solid, signal, because it would be more solid if the market was oversold, because then you'd have that idea of, reversion to the mean and all these other dynamics key in. So if I can summarize it, the closer you get to the extreme, the more predictive the divergence is. Is that what you're saying? I would tend to say yes, or the higher degree of likelihood that signal is a strong signal. Correct. Mm-hmm. And that's a question many people have about technical analysis. Looking backwards, it makes a lot of sense and you can write a good narrative, but give us a sense for the predictiveness of it. Obviously, you must think there's some predictiveness to it. That's why you're talking about it here. Can you explain that for us a little bit, elaborate? Sure. One thing I always do, and I write technical notes to our clients, and as a technician, I believe, if I see something where I see this looks like a bullish divergent setup, I always indicate a technical level where this will be, declared null and void, where if market action moves a certain way, then the signal's been washed out. Because of course, if we knew exactly what was coming, we'd have this conversation on my private island. I'm very generous. You can all come over. Wouldn't be a problem. But the point being, that's the first chart I showed, I've changed how I do my presentations a little bit to show that, in essence, moving the slide through time. That first slide, remember the first one I showed when the divergence set up, I didn't know yet what was coming in the market. but I would have seen that chart. That would have been the only thing showing on my screen at that time when we had, here, let me go back up to it, this guy. So this one here, we didn't yet know. We'd seen the divergence showing up, but yet we obviously didn't know. If I go to this next slide, okay, if I only took that, then of course it sort of looks like I'm cherry picking it. But I had to make this call when this is all I saw on the screen. So I tend to think, it has value, but what you're doing is you're looking at those alarm bells to try and say, hey, the market's been sliding down. Should I think about buying now? This gives you a little bit of an idea to say, this probably is worth looking at this point in time. In terms of the times that it moves, it's a fairly decent predictor because there's a reverse mean dynamic which kicks in. Trends end. Can you stay overbought or oversold for a while? You certainly can. And even this chart, you can have a head fake. This is a little bit of a head fake here. We'd gone sideways and it popped up here, but didn't really lead to a bigger market move before we had that final downturn in that setup. So you have to, it's not a guarantee by any means, but it gives you this idea to turn on your radar, to start paying attention. There might be a change in trend coming. And for that, it's I think, more reliable than not. And again, why not have it as one of your tools to alert yourself to help you make a better decision?
That makes a lot of sense, David. And we got to move on to John. So 2 quick technical questions on technical analysis from members. So index, which one are you using? So for instance, if I'm in California, should I be looking at NYMEX, or is there a better index for me to be looking at?
To do technical analysis with?
Yes.
All right. NYMEX is probably the most useful because you have the easiest and most complete data. If you can but you can use technical tools on any stream of data that you can get prices on. It's the difficulty if you take OPIS West Coast data, incorporating that into a trading platform is not always the easiest thing. So I would probably look at NYMEX data, and of course basis is always an issue we wrestle with customers around the country, and there are things we can do on that. But I would probably be looking at NYMEX data as the most robust set of information on which to do the analysis.
Okay, and the technical question on the calculation of the relative strength indicator. So you said it's average loss divided by average gain. What is the gain and the loss? Is this the daily close? How is that calculated, the daily loss or the average loss, average gain?
It depends on the periods that you're analyzing. So if you have a daily chart, then it's on the daily closes. If you were looking at a 5-minute chart, then it would be on the closes of each 5-minute period. Or if you're looking at an hourly chart, it would be on the close and open and close of each hour. So it's based on the scale of the chart that you're looking at. So most traditionally, you'd be looking at daily closes, so daily gains and losses.
Makes sense. Well, thank you. And if other people have questions, feel free to send them in and we can get back to David near the end of the call. But for now, let's flip over to John Monalepri. So we've talked a little bit about how we can use technical analysis to buy better, but also another key thing that separates top performers from lower performers is those people who are better able to deliver more efficiently. And so, John, step us into that cost to serve and what we can do to automate that process and ultimately make it more efficient and better.
Okay, absolutely. Thank you, Jed, for organizing this webinar, and thank you for those participating. So I'm going to process automation is one of my hobbies, I guess, just because by degree I'm a degreed civil engineer and did civil engineering for 10 years and specialized in process automation at the design manufacturing facility at which I work. So I'm happy to use those skills continually in helping the petroleum marketing industry to automate. So I want to first start by, we're going to talk about our order life cycle and how to improve it through automation. But I want to first start by asking some questions, not for you to answer out loud, obviously, because you can't, but for you to think about what the answers are currently for your company and what they should be, or can you even answer the questions? So one of the questions would be something like, how many phone calls or how many emails, or combination thereof, does it take to deliver an order, or better yet, to find out the status of one of your orders? How many people are involved in your order life cycle process? How many pieces of paper are passed from one department to another? And even more importantly, do you know how many days it takes on average to get an order delivered? How much time after a delivery is made does it take to get the order invoiced? And most importantly, how long does it take to get paid? Everyone, we know everyone wants happy customers and happy owners. Process automation is one of the ways that we can make sure we get both. I'm sure with all the various attendees on this call that there's a wide variation in the degree of process automation that exists at all your companies, but some of you may already be fully automated, while some have maybe little to no automation, but I suspect that most are somewhere in between. The common thing that we see happen in the life cycle of an order is what I call the vicious cycle. Your customers call salespeople to get information on the status of their order. The salesperson in turn then has to call customer service, who then in turn has to call the dispatcher, or dispatcher needs to check with the warehouse, to check with the drivers. And so it's a lot of communication going on from one to another. And this is mainly because each person does not have access to all the aspects of the various stages of the order. So some companies have, multiple people handling order information multiple times, making multiple phone calls and emails. There's a lot of back and forth communication. Lots of waiting on answers from the one person who really knows, who may be on a phone call or at lunch or a break or gone for the day, on vacation, etc. You get the picture. Each person in the life cycle, in the order life cycle process, is very important to the process. However, each person themselves adds time to the process, is a potential bottleneck in the process, and they each have their own unique way of storing and notating information about the order. And in doing so, they create their own little unique bit of knowledge about the order and the process that no one else seems to be aware of. This is not a good thing. So by using technology and automating processes, by integrating industry-specific software, this can improve and help to standardize your current processes, because with an integrated system, the system has all the information for all the steps in the process. The information is stored and shared and accessible to all the necessary personnel so that each one can obtain the information being requested. So this particular slide just showing, if you have a customer portal, the employee portal that feeds in with that, communicates to your back office ERP system. You might have some third-party apps that supplement your back office ERP system. Those need to be integrated with that, with the customer portal. The flow of information between all these systems is very important. The transparency and accessibility of that information is actually really what's the real benefit of an automated integrated process, because with that, no longer does the salesperson need to call the order center or the dispatcher or the driver to find out what the status of an order is. They know it from the system, and they can answer questions for their customers immediately. No more waiting for a callback with the latest status update, etc. The process and the data are standardized within the software, so they know exactly what to look for and where to look for it. So there are some back office systems that are trying to be all-inclusive, having all the modules that you need to operate all aspects of your business, all integrated within one software package. Seems like this might be what PDI is trying to accomplish with all their recent acquisitions. However, oftentimes there's a need to supplement your main back office ERP system with some third-party apps. Either because your existing back office system doesn't have a specific module for a certain aspect of your business, or just because the module is kind of lacking in the features that you need. But here's the key. The key is the integration with these third-party apps that you would supplement and your ERP system. And that's crucial for process automation in order to succeed. So let's take a closer look at what an automated order lifecycle looks like from order entry to cash. So you have your back office ERP system, and the order gets put in there, okay? Either if you do have a customer-facing portal where the customer can log in and place orders, and those flow directly into the system, or through other means, you know, by calling the office directly. But the order originates in the back office system. Then the order information in an integrated automated system would be the data for those orders would be retrieved. Certain business rules would be applied to it to make some decisions about where they need to go, who needs to handle it, what departments, etc. That information would then be formatted and sent to, in this case, for order delivery to dispatch, the appropriate dispatch system, whether it's a module within the system or externally. The dispatcher would then schedule and load those orders for the driver, including the warehouse information for the warehouse loaders to load the truck. The driver can then, that information then gets transported to the driver, say in a handheld mobile device, so that they can make the delivery. They can capture electronic signature, capture the quantities, exact quantities delivered. The proof of delivery gets automatically sent to the customer, and the delivered information sent back to the back office system. So now that information is all this happens behind the scenes, and the information is back at your in your back office system, ready for invoicing. And all of this happens electronically, paperlessly, in real time.
John, do you have a sense for the typical marketer that you work with, how many times they touch a given piece of data, you know, from when that order comes in until ultimately that invoice is sent out to them? I mean, is that 3, 4, 5 times? I mean, the goal, I assume, is let's make it so it's only one touch.
It depends on, everybody seems to be a little different. Obviously, the ones that are still doing a lot of manual things, meaning, you know, they're printing out order tickets, they're printing out pick tickets, you know, those are being, you know, passed from one to the other, and then back from the, you know, to the driver, back to the invoicing people. I guess the average is probably around between 6 and 8.
Wow.
Yeah. For ones that are not automated, yes.
And you'd think that would open the door for a lot of transcription errors to occur, you know.
Absolutely.
Notwithstanding just the person hours to do all of that.
Exactly. So with you know, with an automated process like this, the information about the order is readily available to any user, so that they can communicate, you know, with your customers more accurately and more timely. And so without having to make phone calls or send emails and things like that. But a very important benefit, and this is very important, is that the data, now that you're capturing data electronically as opposed to written on a piece of paper that's shuffled around from department to department and put in an inbox stack, you can't really do anything with that. With this data that's captured electronically, you can then do some analysis and be able to answer some of those earlier questions I asked. You know, what is your order life cycle timeline? Where are the bottlenecks? What areas need improvement? So you can come up with some actionable items. Because if you,
John,
if
for
you
the
can't,
typical, I was going to say, for the typical marketer, where do you see the most common bottlenecks are?
The typical marketer, the most common bottlenecks that I see are typically in the scheduling, the dispatching component. The orders get printed out, into tickets, and they get, I've seen them. The dispatcher has a big desk with stacks of paper that he's shuffling around, and one of them say, "Yeah, I play solitaire with these orders." So they're putting it in rows and columns and trying to figure out, who to, which trucks to load them on and things like that. And that takes a lot of time in sorting through all that information, and then getting all that then reorganized again for the loaders to load up the trucks and things like that. So anyway, so that is so again, the data collection and being able to do analytics, because if you can't measure, you put some kind of measuring stick on what you got going on, you can't fix what you can't measure. So if you're able to know that, okay, yes, my life cycle is 8 days or 6 days or 12 days or whatever it is, then you can see the improvement if you can measure it. So what I want to show you is just as a quick example of software integration using our application DeliveryWorks. Let me just get to, here we go. Jed,
John, is this going to touch on that? Is this going to touch on that key bottleneck area that you were talking about in the dispatch?
That's correct. Yes.
Oh, okay.
So what happens here is through integration with your back office, your orders are still entered into your back office system, but through that integration component, it flows into DeliveryWorks on the left-hand side, this unscheduled orders side of the screen. So these are all the orders that need to be scheduled. On the right-hand side, you have your trucks and your days of the week so that you can schedule things out. If you're using this for fuel and or lubes, you can filter and say, okay, I just want to see all my lube orders, and also just want to see all my lube trucks. Some people filter by warehouses, things like that. But basically you're dragging and dropping your orders. This is your playing solitaire on your desk. You're actually playing it on your computer now, and that opens the door for lots of things. So that bottleneck right there of just sorting through all those orders, is solved by doing lots of filters to hone in on what type of orders, what type of trucks, what areas even. You can set up different schedules and areas and things like that. Also the pick list. So for this particular order here, let's say we can have an electronic pick list instead of having to print another list. And so the loader can come in and say, okay, yes, I loaded 12 drums and I loaded my 5 12 1-quart cases for that order. Also, communication is the key too with the system. So the loader would lock this order, basically saying, okay, I'm starting to load this order, too late, no more changes can be made. Back over here on the dispatch screen, he'll get the dispatcher will see the lock icon, or anybody who logs in to check on the status of an order, so they'll know it'll be being delivered. The driver for that particular truck, he would basically come to his delivery form here, and he would enter the quantities delivered. He would collect the customer signature through a mobile app, and the email receipt would immediately, once the order is marked as delivered, proof of delivery goes to the customer, copy goes back to the office, and you also capture what we call the order timeline that shows you all those metrics, every date, time stamp of every little step along the way. And so same thing with if you're using for fuel and you have fuel orders, you filter by your fuel orders and your fuel trucks. In this case here, we have a pickup order at the Kenner Motiva terminal, and then the delivery order here. So Same sort of application where you would come in and for your transport fuel order, you would go pick up your order from your terminal. You'd put in your BOL number, the quantities that you picked up. So you have that information to tie back to your BOL. And then for your delivery order, when you go to make your delivery, you can basically select from that BOL and put in the quantities delivered. So everything is tied back to that. Get your customer signature. Same thing. Email receipt goes to the customer and back to you. So a couple more points of note to note here. Let me just filter all my trucks again. So you'll see that there's different color codes to indicate different things for the users so they can log in. You can give salesmen, customer service people, view-only access to this so that they can just search and see, okay, yeah, this order's been delivered. It's green with a little white check mark, indicates it's been delivered. They can look out in the future. There's a search order page. So if they're looking for the status of a particular order, or maybe they're looking for a status of an order for a specific customer, they can, one of them scheduled for delivery, the other one's already been delivered. They can look at details. So all this information is readily available to all the players in the game. Now, all that data that's being collected, like I said, is really you can do some good stuff with that. Several different reports that are built in here. That order timeline report is one of the popular ones here, because what you can do is it'll show you how many days to delivery. This particular set here shows an average of 3.17 days to delivery from order entry to customer signature. Time at the delivery, the mobile app that the drivers use will capture the time that you got there and the time you left. So this is showing an average of 15 minutes per stop. But we have captured lots of information here. Every little bit of information you can imagine about the order, from the quantity ordered, the quantity delivered, quantity undelivered, loaded, returned, etc. All that information is here. It's all down. You can download it. And this is where you get into the integration. Different systems may have an upload feature where you can upload this data into there to close it out, or, as I'm going to get into in a minute, some more sophisticated way of integration. All right, so that's what I wanted to show you within DeliveryWorks. And so that when that order is delivered, that information electronically is transmitted into your back office system. So let's go back over here. Oops.
And John, is that invariant of your back office system? So if you had PDI or even
yes,
DM2, which I know they now own, but Factor
yes,
or some other one. Okay.
Yes, we integrate with many of them. And I'm going to get into in a minute here about the integration. So I apologize here. Get back to where I was. Okay. So time savings, obviously, everybody, this is, part of the order life cycle is saving time. And so this was actually a case study that was done for a DeliveryWorks subscriber that does about 3 million gallons of lubricants a year, runs about 14 trucks, and processes about 100 orders a day. Prior to that, their manual process of dispatching was taking them 4 hours a day, and now it's down to 1. And invoicing was taking an hour and a half, and it's literally 5 minutes just to vet the data before clicking the button to generate the invoices. But the big thing too is you can do same day invoicing, because you're not waiting for that paperwork to come back from the driver, because it's there instantly. So the benefits of process automation is a shorter and more efficient life cycle. Basically, the time savings from the manual processes that are replaced by automated processes. The information is more transparent and available. You can give logins to people to see, find the information without having to make phone calls and emails and waiting on information to come back to them. But also, automation forces uniformity in a good way, because it, there's people do, well, yeah, we do this little tweak here, this little thing here, and it, and those are the things, the gotchas that come back to bite you. But so by having some uniformity, it makes the process easier to follow. Basically a place for everything and everything in its place. So if you're going to want to do automation, I know we're short on time here, so I'm just kind of flying through here, but there's a kind of a checklist. So if you're going to integrate software with your back office system, there's some things that you got to make sure that when you're going to purchase some software, whether it's ours or anybody else's, that those software providers and your back office system are willing to cooperate with each other, meaning that they're not, say, well, this is proprietary database, or, this is, you can't have access to this data except through the user interface of our system. You don't want them. There's a few of them still out there, but most players in the game know that that's not the way to play. The accessibility of the database, how easy is it to connect to? Do they have ODBC drivers? How good's their documentation? They provide web services, web hooks, APIs, which is another way to connect and push, not just to get data out, but to push data back in. And then also that their data is in a standard format, their any sort of relational database, not proprietary, et cetera. How complex is that database or the data structure? Do they provide ERD diagrams so you can find your data you're looking for? And if they provide the data to you in CSV or JSON, XML, other industry standard formats. So it's very important to ask these questions before you purchase software if you want to try to integrate that software with your back office ERP system.
So John, as we explore our various back office options, and you're saying willingness of systems to cooperate, et cetera, are important. Specific question, between PDI and Cargus, do you have an opinion between those two? Is one easier to work with than the other? Does one work better with RowLogic, for instance, than the other?
Well, we have experience with PDI, and we integrate with them currently. For Cargus, we have not had the opportunity to do so yet, so I really don't have a straight answer on that.
Yeah, not that you couldn't potentially if they were agreeable to it, but just haven't had the experience.
Right.
Yeah. But overall key, if I'm hearing you right, John, is getting these various systems, because as you said, I mean, maybe one day PDI will be a full system that does everything, but in the interim, which will be quite a while, we're going to be working with a lot of third-party systems and finding ways for those things to integrate with each other to ultimately drive the number of touches out of the system. Is that the big takeaway?
Absolutely, yes. I couldn't have said it better.
Yeah. Well, sounds good. I appreciate you sharing a little bit about what you're doing with DeliveryWorks to help us ultimately improve in that efficiency. As I said, if you look at top quartile performers versus the lowest quartile, one of the key metrics that is this cost to serve, and how do we become more efficient, drive man hours out. And so some of the things that you talked about in here, John, are particularly apt as we all look to improve. And as data is becoming more and more available and software, implementing those into our systems, they're big projects to do, but have long-run benefits for us. And David, just to bring you back on as we close out here, any last big takeaway you would like people to have from your presentation on technical analysis?
I'd say this, just remember, build slowly, don't do analysis paralysis. Find a couple of things that work well with how you're looking to make your market decisions. And then, become comfortable with that and use it on a consistent basis. And I think you'll start to see the benefits of it.
Sounds good. Well, thank you again, David. Thank you, John, for your time on the call. Thank you, audience, for being on the call too. We will send out the slides from both of these presentations along with a link to a replay of the video. As you close out, there'll be a short 3-question eval. We'd encourage you to fill that out, and hope you found this time valuable and there was a couple takeaways for you. Wish you a great day and happy Thanksgiving. Goodbye.
Thank you, Jed.
Thank you.